Markets have been strong over the last month, with global equities up 5.5% year-to-date in local currency to mid-June, or 7.7% in euro terms, while Eurozone bonds are up 9.4%. Continued confirmation from central banks that interest rates will be maintained at current levels for a considerable time, and new policy measures from the ECB contributed to the recent gains. Perceived low levels of risk and a generally improving global economic backdrop have also been supportive of equities in particular. The ECB surpassed market expectations at its early June meeting when it announced a number of new policy measures. Firstly, it reduced the main refinancing interest rate by 0.1% to an historic low of 0.15% and introduced a negative deposit rate of -0.1% on deposits held by banks at the ECB in an effort to encourage them to increase their level of lending into the economy. Secondly, it announced a targeted LTRO, long-term refinancing operation, whereby up to €400 billion funds, or approximately 7% of loan books, will be made available to banks at the relatively low rate of 0.1% above the refinancing rate for 4 years, on the condition that banks increase lending. Thirdly, it indicated significant work is being done to create an ABS, or Asset-Backed Security Purchase Programme, which would involve the purchase of pooled, collateralised assets, again in an attempt to increase the supply of credit and lower borrowing costs across the Eurozone. Finally, it said bond purchases made under the Securities Market Programme in 2010 would no longer be sterilised, which immediately adds €160 billion of liquidity to the system. In addition, while suggesting that interest rates have now reached their lower bound, the ECB highlighted that the fixed rates on the new 4-year LTRO strengthened forward guidance, thus indicating that interest rates are unlikely to rise at least until 2018. President Draghi also said that the ECB is not finished here, holding out the prospect that additional measures could be announced in coming months. With these measures, the ECB is trying to improve the monetary transmission mechanism, particularly in peripheral countries, where the supply of credit has been tight and interest rates on loans have been higher than in core countries. By improving the flow of credit, growth should improve and the threat of Eurozone deflation should also be reduced, while the increased level of monetary stimulus has also led to a weaker euro. As shown in the chart, the narrowing of peripheral bond spreads in Italy and Spain against Germany, which has been evident over the last 2 years, was reaffirmed by the policy announcements. With the ECB's apparent determination to improve the flow of credit and growth in peripheral countries, and indications that further measures are possible in coming months, these spreads are likely to narrow further. Similarly, the euro has fallen in recent weeks as the prospect for more stimulus from the ECB has increased, and with asset purchases under QE3 in the US set to end later this year, this trend could continue. The continuation of accommodative global monetary policies, an improving economic environment, low levels of risk, and valuation levels which are not stretched and which are attractive relative to other assets provide scope for further upside in equities. Wage and price inflation measures do need to be watched to ensure central banks in the UK and US are not falling behind the curve. But to date, these inflationary pressures are well contained and are not suggesting interest rates could rise earlier than currently anticipated by markets. While bond yields in core global markets such as the US and UK are likely to drift higher by year-end, recent actions by the ECB probably limit the upside in core German yields, with only modest upside likely through the remainder of 2014, as the possibility of further ECB policy announcements, combined with official interest rates on hold for a number of years, cap German yields. Recent developments, however, support further narrowing of spreads in peripheral bond markets against German yields.